5 stocks that you as an investor need to pay attention to. I am going to run through them from number 5 to number 1 that I want to own, and we'll see where we end up. So number 5 on the list, Nike. I cannot wait to own this company. I'm wearing a couple of things that are Nike right now. Let's check out the 8 pillars on this. This has been on my watch list for quite some time. And just looking at an overview of the 8 pillars, 5-year price to free cash flow, 40, 5-year PE ratio, 39. To me, all this does, I know Nike as a company is a really good financially sound company, but this pretty much tells me, hey, this could be a little bit overpriced. So why don't we go through here and see what the analysts have to say and run a quick stock analyzer on it. So the analysts for earnings per share are expecting, low 21% average maybe at a quick glance growth through 2027 and revenue growth of, call it 4% over the next 5-6 years. So let's go here and put in our stock analyzer. Now remember, let's look at the income statement real quick because China is a big part of this. So they had very consistent growth, a little bit of a COVID boom here, continued into 2022. Now, I remember reading stories about Nike that said China is getting a little bit iffy, and this is because of their COVID zero policies. It's not a forever situation. So I am going to tame the revenue growth a little bit just because it got a little bit of that bump from COVID. But overall, I think everything is pretty okay. You know what? I'm going to go 2, 4, and 6% revenue growth. I'm going to go 6 is high, but I think 2 is low. So that 4 is probably that sweet spot right in the middle. I will go with 10, 11, and 12% profit margin. Free cash flow margin, 8, 9, and 10. 10 may be a little bit high, but 8, anything lower than 8 would be too low in my opinion. 14, 16, and 18 on price to PE and price to free cash flow. 18, I like that because they pretty much do have a moat. And I'm going to go 12, 13, and 14% return. Click the analyze button. Current price is about $104. And you know what? To me, Nike is probably, and I'm willing to pay a premium for Nike. This is on my watch list at $80 right now. I'm probably looking at this seriously somewhere around this $55 range, which is the high side. And I don't say that for a lot of companies, but for a company like Nike that has a really good moat, has a really good brand, makes really great products in all different sports and arenas, that is a company that I want to own. All right, company number 4, Costco. I'm going to switch this to light mode just because I feel like in a lighter mood today. All right, Costco. This is a company that Charlie Munger has said, I do not ever want to sell. And he was saying that from the perspective of his children actually owning when he passes because he's almost 100 years old. 5-year PE ratio, 53.6. To me, this is egregiously expensive. And I listened to a talk that Monish Pabrai gave over the weekend, and he was talking about when to sell a stock. And he said, I would sell a stock that is overvalued, not just because it's overvalued, but because it is egregiously overvalued. And I look at these two numbers right here, 5-year price to free cash flow, 5-year PE of mid-50s. That's egregiously overvalued in my opinion. I would be a seller at this price if I owned it, but I'm not, and I can't wait to own it someday. So just looking at their ROIC of 13.5%, very little debt, great brand, great Kirtland brand. Income statement, did they have any big bumps for COVID? Yes, they did. So this does make me say, hey, when I do my revenue growth, I'm gonna probably bring this down a little bit. 129 billion, 141 and a half, 153 billion. 167 billion, 196 billion, 227 billion. Those are some pretty big jumps from COVID, not surprising, but we'll just factor that in. The shares outstanding part that I saw, it doesn't really bother me that much. I'm just happy that they weren't buying back shares at these types of valuations. Let's see what the analysts have to say. Okay, year over year, earnings per share growth of about 10%, maybe 11% over the next 5 years, and revenue growth, interesting. And I bet this drop in revenue coming from, actually, I'm surprised that it's only 7 analysts on a company like Costco, but I'm guessing this is because they are kind of taming those numbers that came off of the highs of COVID. So let's go in here and put in some numbers. So on the low end, I will go 1, 3, and 5. 5 could be a little bit high, but anything lower than 1, I do not think would be reasonable. I'm actually going to go with 2.5 all the way across the board here because their profit margin seems to be extremely consistent over 1 year, 5 years, and 10 years. I'm going to do the same thing for the free cash flow margin. PE, okay, 14, 16, and 18, 14, 16, and 18. And I will say, I am going to go and try one of their hot dogs and pop combos. And then I'm going to go over to Walmart, Sam's Club, and try it as well and give you guys a comparison. So current price is $522. And honestly, I'm looking at this somewhere in the high side of 185, low end of 140, middle ground of 160. It's on my watch list at 225 to start selling puts. And this makes sense. Look at these PEs. Look at these price to free cash flows. These numbers do make sense. And that's why I'm saying it's egregiously overpriced in my opinion. I don't understand why Munger likes it so much at these prices, but he's Charlie Munger and I'm not. Number 3, Visa. This company is absolutely incredible. Look at this gross profit margin. 80% gross profit margin, 5-year profit margin of 51%. Let's pull up the 8 pillars real quick right here. You notice the common theme, guys. With the exception of the shares that came out of Costco, the common theme is this right here. So these are really great financially off companies that are just a little bit overpriced or overvalued, I should say. So shares outstanding, they're buying them back. Don't really love that. Return on invested capital is nearly 21%. You can see that there's basically no debt. And who doesn't have a Visa card in their pocket? Right now, it's possible that I have 2 or 3 Visa cards in my pocket. Tim, I'm sure you have a Visa in your pocket as well. Let's look at analyst estimates. Year-over-year growth. They're not going to stop growing. Going into 2026, mid-teen earnings per share growth, and going into revenue, well, they're kind of all over the place too. They're seeing a not decline in revenue, but slower growth 5 years out. So let's see what we're going to put in for stock analyzer tool. I am going to, on the low end, I will go 3, 5, and 7. Now I do think that that's conservative, but I'm going to align myself with what the analysts are saying going into the future. Profit margin 50%. I'll go 48 on a bad day, 50 and 52. Free cash flow margin. Wow. You know what? I'm going to put in the same numbers, 52. PE 14, 16, and 18. A lot of these companies have that moat factor. So even though they're as big as they are, I do think that going with that PE ratio of 18, it's not totally outlandish. $206 is the current share price. And yeah, basically needs to fall quite a bit. $83 on the low end, $120 on the high end. And look, based on these again, what are we waiting for? Just waiting for these prices to fall. And while I'm at this one, I'm going to throw this on here on my watch list. I'm going to put it on there about $150. And of course, the reason is so that I can sell puts on it at a later date in the future. Next stock, number 2, Microsoft. Who doesn't want to own Microsoft? I mean, this is an unbelievable business that has been around for some time. And you guys remember, Paul always talks about when people were saying this was a dead company back in the day. Again, what we're seeing here, the same 2 metrics. We have 6 out of 8 pillars that are green, and those 2 metrics that are just showing, hey, potential overvaluation. Return on invested capital is incredibly high. Price to sales ratio, nearly 9. Gross profit margin, 68%. Do they pay a dividend? They do. Very, very comfortable dividend, paying $18.5 billion out of $63 billion. And even if you want to look at the 5-year, $48.7 billion. I mean, guys, this is an incredible company, one that I cannot wait to own. It's just a matter of waiting. What do the analysts have to say here? Man, their subscription business is so incredible. Looking at earnings per share growth, nearly 20% going 5 years out. And looking at revenue growth, high single digits, low teens revenue growth. So stock analyzer here. Let's go with 4, 6, and 8. Profit margin of 29, 31, and 33. I think it could be a little bit high, but we'll go with it. 29, 31, and 33 for free cash flow margin, 14, 16, and 18, 14, 16, and 18. Again, with that incredible moat that Microsoft has, I am going to give them an 18 PE on the high side and 13, 12, 13, and 14. Now, guys, I haven't talked about this. The reason that I'm putting in these desired annual returns of 13, 12, 13, and 14, if you watch other videos, I could go 12 and a half sometimes. I'll go 15 sometimes and 17 and a half. That's kind of my range. Sometimes I'll go 20+% depending on a company. Sometimes my low end will be 14% or something like that. But with the companies like this, I don't really feel like I need a crazy, egregious margin of safety. If I can get a 12% return on Microsoft with these assumptions on the low end, I will be a very happy camper. But I need to get a minimum of 12, 13, 14, somewhere in there, because I could just put my money into some type of tech ETF, some type of S&P ETF, and get a return of 10% over a long period of time. So I want to get a little more juice for the squeeze. So $243 a share currently. Let's click analyze. I'm probably looking somewhere in this 150 range. That's probably my price. Low end 106, high end 161. You can see it's on my watch list for 200. Same reason. When it gets to 200, I like to sell puts somewhere in that 150, 140 range. And I actually did at some point. Actually, what is the low on this thing? The 52-week low, 213. It's funny. When it got to 213, there was one day when it spiked down a lot, and I was able to go in and sell some puts at that 150 mark. And now, of course, they're gone, and that's never going to happen. But patience is a virtue. Now, let's reveal stock number one on my list that I want to own. And you're probably guessing it's Apple. It's actually not. The reason is I already own Apple, and luckily my cost basis is $17. So I have to put in something else that's number one, and that number one is Google. So with Google, this is the unbelievable business that everybody is using. And I look at this and say, when other parts of the world that don't have phones readily available right now, the first thing they're going to do is open their iPhone or Android phone, and what is the first thing that they're going to go to search something? It's going to be Google. So yeah, is advertising struggling at this moment in time? Sure. But over a long period of time, 10 years, 15 years out, do I think that advertising online is going to be bigger than it is today? Bigger. Is there going to be more revenue and profit in that industry? Yes. And that's why I like Google right now. So let's pull up the 8 pillars. It's getting very close to my price, and I'll reveal that in a little bit. I've done a lot of due diligence on this. I've sold some puts on this one, but right now, that PE, that 5-year PE, still a little bit high, and that 5-year price to free cash flow, still a little bit high. So outside, every single stock was just this, except for Costco, which had some shares, some dilution. But every single stock on my list is just showing overvaluation. Gross profit margin, 56%. ROIC, awesome. You know, I was listening to again, Monish this weekend, and he said when he likes to look for multi-bagger companies, he looks for a couple of things, 3 things actually. Number 1, very high ROIC on money that they have, not going on debt. He also looks for companies with really good and vested interest into integrity from ownership. He wants to see that ownership has some insider shares in the business and that they can go on and say, hey, we want to grow this company because as this company grows, our portfolio grows. And third, you want to have a company with a long runway, meaning that when you get into this thing, you see a long time on the horizon where you can be invested in this thing, like a Google, like a Microsoft, something like that, not like a McDonald's. Now, I think that Google hits all of those marks, has high ROIC, it does have insiders invested in the company, and I think that when I think of the internet, Google is synonymous with the internet. So that is why I'm looking at Google. Now let's see what analyst estimates are. Analysts are saying, wow, mid-teen earnings per share growth into 2026 and revenue growth of, let's call it high single digits on average. So before I run Stock Analyzer on Google, I want to show you how our 8-pillar software works, how we look for companies, how Paul and myself go and find companies that we really want. And for me, like I just said, return on invested capital over 9 years. This is how well the company does, basically investing their own money. So when I look at a company like any basically Fortune 500 company where I have zero chance of going and talking to the CEO, going and talking to the CFO, going and talking to high-level management. This right here tells me how good the company is and how good the management is. It's not just rock solid where that works. But when I see high return on invested capital, I say, okay, this management kind of has a pretty good idea of what they're doing. So let me go here, tools, 8-pillar search, and I'm just going to pull out companies with high ROIC over 9 and look at that. Just like that, I have tons and tons of companies where I can go through and say, hey, these companies have a ROIC over 9% as a 5-year average. Pepsi, Johnson & Johnson, Sprouts Farmers Market, Bath & Body Works, MasterCard, Colgate, Anthem, that's the insurance company, Louisiana Pacific, that's a company that Warren Buffett and Berkshire Hathaway were just getting into, Philip Morris International, Old Dominion, big shipping service around the country. So you can see all of these big companies out there that say that I don't have a chance of going and talking to management, but I can say, hey, they have a ROIC that's greater than 9% over the last 5 years. They're probably doing something right in that department. So let's go back to our Google and pull out what we think, well, what I think will be an appropriate price to pay for this stock to make a good return over a long period of time. So I'm going to do my usual 10-year analysis. And let's see, why don't we double check what they were saying? Okay, so let's go in here and say let's say things don't work out for them. 8 and 12. Profit margin, 22, 23, and 24. 22, 23, and 24. PE, 14, 16, and 18. 14, 16, 18, and I'm going to go 12, 13, and 14% return. Current price, $96. And look at that, $64 on the low end, $125 on the high end, meaning that we're in the money, and $90 on the middle ground. For me, you could see it's on my watch list at 80, and I probably want to start acquiring these shares probably $75, somewhere in there. So maybe $70, and I have it at 80 because I already have puts on it. When it hits 80, I want to sell even more puts on it. But what this green number means, this is the first green number that we've seen from any companies that I've pulled up. It means, if my assumptions here are correct, that they are going to do revenue growth of 12% over the next decade. They're going to get a 24% profit margin, 20% free cash flow margin. They can justify a PE of 18, a price to free cash flow of 18, and they're going to give you a 14% return, then you should be buying Google right now. Now, I don't necessarily believe those numbers. I do not want to error to that side. I want to error somewhere towards this side, maybe the middle ground right here. And that's why I'm not buying Google right now. But these are the 5 stocks that you as an investor should pay attention to, and I am certainly paying attention to. So guys, if you want these tools, go to everythingmoney.com, join it. You are going to love it. And also subscribe to this channel. We do tons of reaction videos. We do earnings reactions videos. We do tons of educational videos like this. There's 1,800 videos out there. Go subscribe. You'll love it. Have a great day.